Value investing created some of the greatest fortunes in market history. The idea sounds simple. Find a company trading for less than it is worth, buy it, and wait for the market to catch up. But over the last decade, something uncomfortable happened. The expensive looking growth stocks kept winning, while many of the supposedly cheap stocks kept falling further behind. So is value investing dead, or have investors confused buying cheap stocks with buying valuable businesses? Today we are looking at what the numbers actually show, why the traditional version of value investing has struggled, and whether the strategy still makes sense for investors today. As always, this is educational content, not financial advice. Do your own research before making decisions with your money. Part 1. Value has fallen far behind. Let's begin with the part that value investors cannot ignore. Over the 10 years ending in June 2026, the S&P 500 Growth Index returned approximately 16.8% per year. The S&P 500 Value Index returned roughly 9.3% per year. That might not sound like an enormous difference, but over a full decade, the gap becomes massive. A $10,000 investment compounding at 16.8% would grow to roughly $47,000. At 9.3%, it would grow to around $24,000. Same starting amount, same 10 years, almost twice as much money. Growth clearly won that period, but this is where we need to be careful. 10 years of underperformance does not prove that value investing is permanently broken. It only proves that growth stocks perform much better during this particular period, and choosing a strategy based only on what performed best recently is exactly how investors end up buying after prices have already risen. Part 2. Cheap does not automatically mean undervalued. The biggest misunderstanding about value investing is that it means buying stocks with the lowest price to earnings or price to book ratios. That is not value investing. That is screening for cheap looking stocks. A stock can be cheap because the market has overlooked it, but it can also be cheap because the business is losing customers, carrying too much debt, facing declining profits, or operating in an industry that is slowly disappearing. That is known as a value trap. The valuation looks attractive, but the underlying business continues to deteriorate. Real value investing is not about finding the lowest number on a stock screener. It is about estimating what a business is reasonably worth and paying less than that amount. Sometimes the lowest priced stock is undervalued. Sometimes it deserves to be cheap. Part 3. The accounting system has changed less than businesses have. Traditional value metrics were developed during an economy dominated by physical assets. Factories, machinery, inventory, land, and equipment appeared clearly on company balance sheets. That made book value a useful way to estimate what a company owned. But many modern companies create value differently. Their most important assets may be software, research, data, intellectual property, networks, customer relationships, or brand recognition. Much of that value may not appear on the balance sheet in the same way as a factory or a piece of machinery. So, a company can look expensive based on book value even when it owns valuable assets that traditional accounting does not fully capture. This does not mean valuations no longer matter. It means that relying on a single traditional ratio can give an incomplete picture. A better analysis may also consider free cash flow, returns on invested capital, balance sheet strength, competitive advantages, and the company's ability to reinvest profitably. Part 4. Some growth companies actually delivered. There is another reason growth stocks perform so well. Some of the companies investors paid high prices for went on to produce exceptional revenue, profit, and cash flow growth. The market was not always blindly overpaying. In some cases, the underlying businesses genuinely became more valuable. This exposes another common value investing mistake: automatically assuming that a high valuation means a bad investment. A company trading at a high multiple can still be undervalued if its future cash flows grow faster than the market expects. And a company trading at a low multiple can still be overpriced if its profits are about to collapse. Price matters, but price without business quality and future cash flow tells you very little. Part 5. Interest rates are not the full explanation. Very low interest rates during much of the previous decade help support higher valuations for growth companies. When rates are low, future profits are generally worth more in today's money, which can make long-duration growth businesses more attractive. But that explanation is incomplete. Interest rates later rose substantially, yet the growth index still maintained a major 10-year advantage over value. As of July 2026, the Federal Reserve's target range was 3.5 to 3.75%, meaning the market was no longer operating in the near-zero rate environment that defined much of the previous decade. So rates influence the outcome, but they cannot explain everything. Business quality, earnings growth, market concentration, and investor expectations also mattered, and nobody can know with certainty which factor mattered most. Part 6. Is value investing actually dead? No, but the lazy version of value investing probably deserves to be. Buying a stock simply because its PE ratio is low is not a complete strategy. Buying a struggling company and assuming it must eventually recover is not a complete strategy. And ignoring business quality because a stock looks statistically cheap can be extremely expensive. Modern value investing requires a broader question. What is this business likely to earn over time? How durable are those earnings? What risks could destroy them? And what price am I being asked to pay? That approach can include traditional value companies, but it may also identify value in profitable businesses that do not look conventionally cheap. Value investing was never supposed to mean buying the cheapest company. It was supposed to mean paying less than something is worth. Part 7. What should a beginner do? For most beginners, analyzing individual companies is harder than it looks. You need to understand financial statements, competitive advantages, debt, management incentives, industry risks, and valuation. And even after doing the work, you can still be wrong. That is why a low-cost, broadly diversified index fund remains the simpler option for many investors. It removes the need to decide whether growth or value will lead during the next decade. You own both. You participate when growth companies perform well, and you still hold value companies if the market cycle changes. That may not be exciting, but investing does not need to be exciting to work. Investors who genuinely enjoy company analysis can still use a smaller part of their portfolio to study and select individual stocks, but they should be honest about the difficulty involved and avoid treating a low valuation as proof that an investment is safe. Even professional active managers struggle to outperform consistently. In 2025, 79% of active US large cap funds underperformed the S&P 500. And S&P's persistence research found that sustained outperformance was rare. Let's conclude, value investing is not dead, but it has been misunderstood. The strategy is not about buying bad businesses at low prices. It is about buying businesses for less than their future cash flows are reasonably worth. Sometimes that opportunity appears in a traditional value stock. Sometimes it appears in a company with growth potential, and sometimes the most honest decision is admitting that you cannot value the company accurately and simply owning the market instead. Growth dominated the last decade. That does not guarantee it will dominate the next one. The lesson is not to abandon value investing. It is to stop confusing cheap with valuable. What do you think? Is value investing still relevant, or has the market changed permanently? Let us know in the comments, and subscribe to Growth Minded for honest videos about investing in personal finance without the hype.